If you're in your 20s and you're still researching what the optimal portfolio is, I need you to hear this. Every month that you spend hours watching videos like this instead of just investing is costing your future self thousands of dollars in compound growth. And you're not losing this money because you're picking the wrong investments. It's simply because you're not taking action and investing at all. And I get it because when you start investing, it does feel like there's all these conflicting opinions on how to build the optimal portfolio. You have the guys that swear by dividend investing and swear that all you have to worry about is passive income rather than long-term growth. There's the crypto crowd telling you that you only need to focus on investing in Bitcoin and nothing else. And then you have the finance bros that are telling you that they found the next Nvidia or the next Tesla and that you should just focus on individual stocks if you want the best returns. And all of this noise around investing is what makes you feel like you can't start until you've found that perfect portfolio. But here's the truth. The biggest predictor of whether or not you actually build wealth in your 20s has nothing to do with what you actually invest in. It simply comes down to whether or not your portfolio matches your personality well enough that you won't abandon it or start selling stocks when the market drops 30%. Consistently investing in a less than optimal portfolio for 20 or 30 years will pretty much always outperform a perfect portfolio that you quit or start changing after 6 months. So in this video, I'm not going to be giving you like 47 different ETF combinations that you can pick and choose from for the optimal portfolio. I'm simply going to give you 3 different portfolio archetypes that match how guys in their 20s typically think about money. So by the end of this video, I want you to find your archetype, set it up in a brokerage account, and then stop worrying about whether or not it's the most optimal portfolio. So the first archetype is going to be the overthinker. And I think this is the category that most guys fall under when they first start investing. And let's be real, I think most of us still have a lot of overthinking tendencies when it comes to investing. And it makes sense because most of us are going to work for 40 or 50 or even 60 plus hours a week trying to get a bag. And then the whole premise of investing is that you're taking that hard-earned money and then putting it in the trust of another company to pretty much turn a profit for you. And if that company goes bankrupt, that's pretty much hundreds of hours potentially of your own time just thrown down the drain. But the problem is that this level of overthinking leads to one thing, and that's analysis paralysis. You're probably opening up all kinds of spreadsheets trying to calculate your returns. You're probably doing endless research, just watching YouTube video after YouTube video, trying to make sure that you have the most optimal portfolio, but all the while, you're not taking any action towards actually investing. And the honest truth is that no matter what you invest in, you're never going to have the perfect portfolio. Pretty much every investment has plenty of pros and plenty of cons. But if you're someone that overthinks about investing, there is a way to structure your portfolio that will continue to grow your wealth while also keeping you sane if there's a big market swing. And for this archetype, I'm going with the Boglehead 3 Fund portfolio. And for those of you that have never heard of the Bogleheads before, they're essentially a group that's just obsessed with trying to make sure you're investing in the most dead simple portfolio possible. That way there's really no way to mess it up. And the first component of this portfolio is going to be the US total stock market, which is going to be a 60% allocation. Now, for this, I'm recommending the ETF called VTI, which is essentially letting you invest in every single stock in the US stock market. And in my opinion, there's really no better ETF for beginners because if you're investing in literally every single stock in the US stock market, there's almost no way to lose because naturally every single company is going to be trying to become more profitable over time. And certainly some of those companies are going to go bankrupt or never be profitable, but the majority of them are going to find ways to be successful, meaning that over a long period of time, you're going to reap those gains. And a 60% allocation is enough for you to see a good amount of growth when the US market is strong, but your portfolio is also not going to be tied to the health of the US economy and stock market. Now, the next 20% for this portfolio is going to go to international stocks, and for this, I'm recommending the ETF VXUS. And the reason that international stocks are so important for this portfolio is due to the fact that historically there have been periods of times where the US market has been down and the S&P 500 has been at a loss. Meanwhile, those international stocks have been well outperforming. And people often use recency bias to justify only investing in US stocks because Let's be real, over the past decade at least, the US market has definitely outperformed any international stocks. But if you're looking at a 30 or 40-year time horizon, I think there will definitely be another time where the US market is going to crash and those international stocks are going to keep on rising. So when the next market crash hits and all your friends are panicking because they only invest in the S&P 500, you can be rest assured knowing that your portfolio is going to stay afloat. So the final 20% of this portfolio is going to be allocated to bonds, and this is pretty much to provide a safety net for your portfolio. And for investing in bonds, I recommend the ETF with the ticker symbol BND. And while bonds aren't really going to give you much of a return in the long run, they're pretty much there to play the role of keeping you sane and level-headed whenever a market downturn happens. That way you can sit back and allow your portfolio to continue to build wealth for you rather than start panic selling. And I think the main argument against the Boglehead portfolio is that it's not really optimized for growth, and realistically you could probably earn more money in other investments. But let's be real here, I don't think anyone who's retired is going to be losing much sleep when they only have $3 million in their portfolio rather than $3.5 million. So the second archetype is going to be the chill guy. And really, I think that most of us guys in our 20s probably fall under this archetype. Most of us are just working a 9 to 5, you probably come back and hit the gym. Maybe your day ends with some video games, or maybe you've got some other hobbies you've enjoyed. Maybe you are dating, or maybe you're part of a rec league. But whatever it is, you don't really want to spend your whole life worrying about micromanaging a portfolio. All you want is good growth over time without having to really worry about your investments. So for the chill guy, I've decided to go with a more modified version of the Boglehead setup, and that's going to start with 80% allocated to the total US stock market. And I think this is the perfect base for this portfolio because it gives you that consistent long-term growth without too much upside volatility or downside volatility. There may be years where you're up 10, 20, 30%, and there may be years where you're down 20%, but over time it's just going to average out to around a healthy 10%. This portfolio is then going to have a 10% allocation to international stocks, and this is so that the portfolio still gets some of that diversification into other markets in case the US market does crash. But I am saving that extra 10% to put into things that may have higher growth over time. And with that extra 10%, I want to allocate towards a higher growth ETF. And for me personally, my favorite in this category is SCHG. It's a low cost ETF and it's performed really well over the last few years, and I've really made a lot of money from it. So this is what I'm putting here in the portfolio, but you can also look into some other high growth ETFs. Like I think there's a good one Vanguard makes called VUG. But whatever it is, this 10% is going to allow you to have a little bit more upside without taking too much extra risk. And I think this portfolio is going to be optimal for guys that want that solid growth without having to obsess over it. So the third and final archetype is going to be the Wall Street bets guy. And maybe it's you, but I'm sure we all knew a kid in high school that was just convinced he was going to retire his parents off of sports betting. And then that next summer, you saw him working at the local Wendy's. And the Wall Street Bets guy does have a lot of the same qualities as the other two archetypes, but the main difference is that the Wall Street Bets guy wants to retire as soon as possible. It doesn't care what type of risk it takes to get there. But the problem is that that's not really how traditional markets work. And sure, you could trade options or put all of your money into a single stock, and yeah, you could make $1 million overnight, but just as fast, you could lose everything you've ever worked for. So for this archetype, the portfolio is designed to have some asymmetric upside and volatility, while also having a protective base that's not going to let you lose all of your money in a market downturn. And for this base, we're going with a 60% allocation to the total US stock market, and this is essentially there to keep you grounded while things like tech and crypto are crashing. But here's where it's going to start to get a little bit more interesting. The next 30% of this portfolio is going to go towards a high growth asset of your choosing. Now, if you want to keep it simple, this could still be the high growth ETF SCHG, or if you want to have a little bit more fun with it, you could start picking some individual stocks like maybe Nvidia or Amazon or Microsoft. I mean, obviously don't pick any super chaotic or risky moonshot type stocks. But a lot of these more established stocks I think are fine to be a part of this portfolio. But whatever you're convicted to and that has a high growth upside, that's what goes in this 30%. And the final 10% of this portfolio is going to be allocated to Bitcoin. And yes, I know it's volatile, and yes, people have different opinions on where this is going to be in 10 or 20 years. But me personally, I do think there's a real high upside here as long as you can stomach the volatility. Because one day Bitcoin will be up 50%, and the next it'll be down 70%. But if you can hold out over many years, I think you can definitely see some nice returns by having 10% of your portfolio allocated to this asset. And on the flip side, having just 10% of your portfolio allocated to Bitcoin keeps most of your wealth intact in the event that Bitcoin just gets absolutely wrecked and just goes to zero. So while this portfolio might be a little bit riskier than something the Vu and Chill crowd would approve of, it's definitely not a meme portfolio, and I think it has the chance to provide some real accelerated upsides while also protecting your downside from any major crash. So if you're in your 20s, the worst investing mistake that you can make is simply not investing at all. But if you know your archetype and you set up that investment portfolio and stick with it for decades, you'll do better than 99% of investors out there. And you'll certainly become wealthier than the guy that decided to spend another 6 months researching the optimal portfolio. The truth when it comes to investing is that there's never a better time to start than right now. And the regret of starting when you're 30 or 40 is going to weigh a lot heavier on you than the regret of picking an imperfect portfolio when you're 21 years old. So drop a comment down below on which archetype most closely matches how you feel. And also let me know, do you agree with these portfolios? I'm pretty curious to know what everyone thinks. And if you enjoyed the video, please leave a like and subscribe, and I'll catch you guys in the next one.